In December 1974, the government of Portugal, a provisional government in the process of establishing a democracy, feared that it was facing an economic crisis. Business owners, alarmed by the rise of leftist political parties, issued dire warnings about plunging production. Newspapers speculated that the economy had shrunk 10 to 15% since the 1974 revolution that had overthrown the country's long-standing dictatorship. Some Portuguese were pronouncing democracy a failure. Others declared that capitalism was the culprit. But how bad was the situation really? It turns out some MIT economists found that, in fact, the economy had shrunk only 3%. And since that time, Portugal has, on the whole, been a success story. What is the lesson here? That economic measurement matters. Good policy relies on good measurement of what is happening in the economy as a whole. In this section, we will start with a set of measurements known as the national accounts that keep track of spending households, businesses, and government have in the marketplaces. In this module, you will learn how economists use aggregate measures to track the performance of the economy, the circular flow diagram of the economy, and what gross domestic product, or GDP, is, and the 3 ways of calculating it. The national accounts. National income accounting is a method of measuring the many flows of money in the economy. These accounts are important for governments trying to measure the state of the economy. The more reliable the accounts, the more economically advanced the country is in most cases. In the United States, these numbers are calculated by the BEA, the Bureau of Economic Analysis. National income and product accounts, often referred to simply as the national accounts, keep track of spending of consumers, sales of consumers, business investment spending, government purchases, and a variety of other flows of money that come together in the circular flow model. By determining reliable numbers for these accounts, governments have good information on which to make future decisions. The next model we're going to look at is the simple circular flow model. Circular flow simplifies the macroeconomy. It shows the flows of money, goods and services, and factors of production through the economy. The underlying principle is that the flow of money into each market or sector is equal to the flow of money coming out of that market or sector. Let's examine each part of the model. There are 2 groups of decision makers in this simple version of the circular flow: households and businesses. Let's begin with the product markets, which in this version of the circular flow diagram are on the left. A product market is where goods and services, such as cars, computers, and corn, are bought and sold. Households are on the demand side of these markets, purchasing goods and services. Businesses are on the supply side of these markets, offering products for sale. Interaction of this demand and supply determines the price of each product, just like we studied in the free market model. Flow of consumer expenditures constitutes sales receipts for businesses. So households give money to the firms in exchange for these goods and services. Now, let's look at resource markets or factor markets on the right. A resource market is where a resource, land, labor, or capital, is offered for hire and employed. Households supply resources directly, such as workers, or indirectly through ownership of corporations. Businesses demand resources in order to produce goods and services. Interaction of this supply and demand determines the price of each resource, which is in turn the income for the owner of that resource. And supply and demand work in the factor markets just as they work in the product markets. So we have supply and demand of labor, supply and demand of crude oil. Flow of payments from businesses for resources constitutes business costs and resource owners' income. Now let's look at an expanded version of circular flow. The expanded circular flow diagram shows only the flows of money in the economy, but it is expanded to include extra elements that were ignored in the simple model. Still, as in the simple model, the inflow of money into each market or sector should equal the outflow of money coming from that market or sector. This expanded flow connects the four corners of the economy: households, firms, government, and the rest of the world. And you can see that in this version of the model, they are lined up vertically towards the left of the model. The flow connects these four sectors through three types of markets now. We still have the market for goods and services, and we still have factor markets, but notice we have added financial markets. Funds flow from firms to households in the form of wages, profit, interest, and rent through the factor market. This represents firms purchasing resources from the households. After paying taxes to government and receiving government transfers, households are left with their disposable income, which they can either save or spend. Via the financial markets, private savings and funds from the rest of the world are channeled into investment spending by firms, government borrowing, foreign borrowing and lending, and foreign transactions of stocks. In turn, funds flow from the government and households to firms to pay for purchases of goods and services. Finally, exports to the rest of the world generate a flow of funds into the economy, and imports lead to a flow of funds out of the economy. We can determine the total flow of all funds by adding all spending: consumer spending on goods and services, investment spending by firms, government purchases of goods and services, and exports, subtracting the value of imports from the total exports, which gives us the value of all the final goods and services produced in the country, that is, the gross domestic product. Gross domestic product, then, is the total value of all final goods and services produced within a country during a given period, usually a year. Now, looking at some of the words in this definition. First, it's important to always remember that GDP includes only final products and services. It avoids double or multiple counting by eliminating intermediate goods. Final goods are those goods that are ready for consumption, such as a bottle of ketchup at King Soopers. Intermediate goods are those that require further processing before they are counted as a final good. So you start with tomatoes, then you juice the tomatoes, then you have to add other ingredients and make the actual ketchup. You also have bottles that ketchup's going to go in. All of those constitute intermediate goods and services. Another thing to note, GDP only counts production done within the boundary of the nation. If it was produced in America, it belongs in the GDP of America. It doesn't matter where it is actually consumed or where the actual company is headquartered. So General Motors, an American company, has a factory producing trucks in South Africa. The value of those trucks is counted in South Africa's GDP, not in our own. The reason for this is that our workers cannot enjoy that money to go buy goods and services. Finally, remember that GDP is bounded in a given time period. GDP sums the total value of what has been produced in the economy over the year, not what was actually sold. For example, a Honda Civic produced in Kentucky in 2009 but not sold until January 2010 is counted in 2009 production and 2009 GDP. To determine GDP, we have three ways we can do this: the value-added approach, the aggregate spending approach, and the total factor income. We're going to look at each of these as we examine. The first way we measure GDP is the value-added approach. With this method, we look at the value added of each stage of production and what that stage of production adds to the total final good and service. In this case, the value added of the auto producer is the dollar value of the cars it manufactures minus the cost of the steel it buys. The value added of the steel producer is the dollar value of the steel it produces minus the cost of the ore it buys. Only the ore producer, who we have assumed doesn't buy any inputs, has value added equal to its total sales. Notice the sum of the three producers' value added is $21,500. You can see this on the bottom row of this chart. Another way to calculate GDP is the aggregate spending method. Here we add up aggregate spending on domestically produced final goods and services. That is, the flow of funds into firms. GDP is divided into the categories of buyers in the market: household consumers, businesses, government, and buyers from outside of the country. This method can be shown through the equation GDP equals C plus I plus G plus net exports. This is a super important equation that we will continue to discuss throughout the semester, so take a few minutes to really pay attention to it now. C stands for personal consumption spending. It includes durable goods, non-durable goods, and services. For example, a head of romaine lettuce is a non-durable good, a new washing machine is a durable good, a pedicure is a service. I stands for domestic investment. This is all purchases of machinery, equipment, and tools by businesses. An accounting firm buys a new fax machine. A manufacturer buys a new stamping machine. It also includes all construction, including residential construction. So building a new apartment complex or Lowe's superstore would be included in investment. Finally, it includes changes in business inventory. If a company's output exceeds its current sales, unsold inventories build up. So in other words, if a company produces 10 cars but only sells 5, we have a change in business inventory. If businesses are able to sell more than they currently produce, this entry would be a negative number. G stands for government purchases. This includes spending by all levels of government, federal, state, and local, and includes all direct purchases of resources, labor in particular. For example, if the government purchases a heavy-duty van from General Motors, that is government spending. Or if the government hires a nuclear physicist at Los Alamos, that is a government purchase. Finally, we have net exports, which are exports minus imports. All spending on goods and services produced in the U.S. must be included in GDP somewhere. And so this is how we account for that. Often, goods purchased in the U.S. are produced elsewhere. Therefore, net exports is the difference, exports minus imports, and can be either a positive or negative number, depending on which is the larger amount. In our country, because imports are usually higher than exports, the number is typically negative. In this chart, we would find this measurement by looking at aggregate spending on final goods and services, the finished car, which is equal to $21,500, the same value of GDP as in the last method. This is shown in that top row in about the fourth column over as marked. A final way to calculate GDP is to add up all the income earned by factors of production in the economy. The wages earned by labor, the interest earned by those who lend their savings to firms and the government, the rent earned by those who lease their land or structures, the profit earned by shareholders, the owner of the firm's physical capital, all of those incomes. Compensation of employees includes wages, salaries, fringe benefits, salaries, supplements, payments made on behalf of workers like Social Security, and all other health and pension plans. All of that is included in the income method. Rents are also included. So if you rent your land or rent a building space to a firm, that is counted under income. Interest is earned by those who lend their savings to firms and the government. So if you buy a savings bond and you get paid interest on that, that would be counted in the income category. Proprietor's income is income of unincorporated businesses, sole proprietorships, partnerships, and cooperatives. So if you own your own business or small businesses, that income those business owners receive is included in this measurement. And then corporate profit. After corporate income taxes are paid to government, dividends are distributed to the shareholders, and the remainder is left as undistributed corporate profits. Notice this is not buying and selling of stocks, but those corporate profits where a big company like GM turns a profit in a given year. The sum of these numbers equals a measurement known as national income, all income earned by American supplied resources, whether here or abroad. National income demonstrates how the expenditures on final products are allocated to resource suppliers. So national income equals wages plus rents plus interest plus profits. In our simplified economy, the shaded column at the far right shows the total wages, interest, and rent paid by all the firms in the economy, as well as their total profit. Summing up all of these gives us a total factor income of, guess what? $21,500, equal to GDP. Now that we know how GDP is calculated in principle, let's see what it looks like in practice. Here we see the first two methods of calculating GDP side by side. The height of each bar above the horizontal axis represents the GDP of the U.S. economy in 2009, $14,259 billion. Each bar is divided to show the breakdown of that total in terms of where the value was added and how the money was spent. In the left bar, we see the breakdown of GDP by value added according to the sector, the first method of calculating GDP. The right bar corresponds to the second method of calculating GDP, showing the breakdown of the four types of aggregate spending. Notice that net exports goes below the line because our imports are higher than our exports. In addition to the intermediate goods that we've already discussed, the following are also not counted in GDP calculations. Secondhand sales or used goods are not counted. GDP is designed to measure what is newly produced or created over a period of time. Previously existing assets or property that is sold or transferred is excluded. This falls in the do not double count rule. If you buy a new Xbox in 2008 at Circuit City, it would count in the GDP for 2008. If you resell it on eBay in 2010, it is not counted again. Final goods and services are only counted once, in the year in which they were produced. Purely financial transactions are also excluded, like stocks and bonds, or public transfer payments like Social Security or cash welfare benefits, or private transfer payments like alimony payments. None of those are included in GDP.